Do you guys know one thing? The 10-year US Treasury bill is paying around 4%, while the EigenLayer's restaking is paying around 15% with same ETH. In today's video, we are trying to reverse engineer how the institutional money is quietly following the restaking protocols and it is getting away from the bond market. And we are discussing the complete liquidity map of the institutional money that flowing into the restaking protocols. As of today, February 23rd, 2026, the EigenLayer is now holding around 19.5 billion in total value locked. This number didn't existed 2 years ago. For context, the entire high-yield bond ETF market took decades to get where it is. But on the other hand, the restaking protocol just took only 24 months to reach this yield. The actual question is not if this matter, the question is at what point does this bond market will need to react. I will be direct with you guys. I will be keeping the actual question is not if this matter, the question is at what point does this bond market will need to react. I will be direct with you guys. I will be keeping a close eye on the gap between Ethereum staking base yield like 3 to 4% and restaking premium. If you stake Ethereum, you will get around 3 to 4% yield per year. But on the other hand, if you are doing the restaking, you will be using your staked Ethereum to do other extra security stuffs. Right now, the extra reward is around 7 to 15% depending on how much risk you are taking. So altogether, some people are making huge money in here. The key point is that the extra high earning that they are currently making will not last forever. They are unusually high compared to the base rate right now. And the difference, the 3 to 4% versus the boosted 7 to 15%. This is the opportunity where people are watching very closely right now. This chart shows two yields side by side. The white flat line is your traditional 10-year US Treasury sitting around 4%. The sand climbing line is what institutional restaking is delivering through protocols like EigenLayer or Symbiotic and Karak. These are the three dominant players right now in 2026. So what does this mean for your portfolio? It means the traditional definition of risk-free rate has now a competitor. Now the every flow is pricing against it as well. And interesting fact is that competitor can be programmable and it is available 24/7 and does not need a central bank to set it up. Symbiotic and Karak introduced something called asset agnostic restaking. That means it's not about ETH anymore. Now you can restake USDC as well and wrapped Bitcoin and other ERC20 tokens. In this case, this yield surface will go much more wider. This is the capital rotation framework our team tracks. What you are seeing is the institutional money that used to sit in a passive bond ETFs like a lazy capital, as we call it, beginning to move into the programmable restaking vaults right now. BlackRock, Deutsche Bank and Angrock Digital, they all are not doing this for a fun. Angrock now offers a federal licensed and compliant staking access, meaning the institutions can now earn the restaking yield under a regulated wrapper. This is actually a structural institutional shift in the market. Sharplink alone deployed around 170 million in ETH in EigenCloud. EigenCloud is the EigenLayer's AI infrastructure arm. If you want to check more, you can go to their website. But what actually it means is that this is not a retail trades. These are the treasury decisions. So what does this mean for your portfolio? When the big investors like pension funds, hedge funds or banks pull a lot of money out of bond ETFs, it will create a gap in the market. That means there are not enough buyers and that will create a vacuum. When this happens, the central bank will experience a pressure. They have only two choices here. Rise interest rate. It will make the government bonds more attractive, or do nothing, like risk their key interest rate become less important to the market. The data suggests this is a skew here, where markets and the central banks are out of sync and it's already started to happen. Let me clear about when this idea will break, because that's the honest way to look into that. I will be wrong if the restaking will blows up in the practice. If major ABS get hacked or slashing get one of the top liquid restaking tokens. In this case, those extra yield will disappear very fast. The real risk is not about the idea, it's the execution. And on other case, I will be wrong if the 10-year treasury goes well above 5%. At this point, the safe government bonds are start getting more traction and it will outgrow the on-chain yield they are currently getting from the staking, especially for the big institutions. At last, the US regulation will move against the on-chain yield products. What actually is that SEC is currently quiet in this case. That doesn't mean they are approved. Now let's look into how institutional money is actually using the restaking platforms, like how it is being marketed. There are a couple of layers in here. In this case, the institutions will deposit ETH into the liquid staking protocols like Lido or Ether.5. They will get a token back like STETH or ETH, and these tokens will grow in value and stays liquid. In this base yield, you will get around 3 to 4% layer 2 the restaking premium. That liquid staking token you get in previous layer 1 will get deposited into EigenLayer or Symbiotic. The same capital now secure 10 to 20, sometimes additional 50 services like Oracle and data, or maybe cross-chain bridges, and each one pays a fee, and this will get a combined yield of around 7 to 10%. Layer 3, the institutional loop. It's actually a high risk beta. After the restaking, you will get a restaking token, and the sophisticated desks are using these restaking tokens as a collateral in a lending protocol like Aave or Morpho, and they will borrow at a lower cost and reinvest. On paper, that will push total return around 15 to 20% a year. But here is the catch. If the market gets volatile and price drop fast, the liquidations can happen very quickly. And when that loop unwinds, it will unwind really hard here. The emergence of institutional curators are something that most of the people are currently missing here. Those are the firms that will decide which ABSs get your restaking capital, especially a risk managing company or a fund that sits between you and the protocol itself. Ankrok Digital's federally licensed version is a clear example for this. If enough institutional money started to consider this restaking yield as a base return, then the traditional risk-free return that's set by government will start looking outdated. In other words, investors may stop seeing government bonds as a default benchmark. The model suggests that the shift is really early right now, but we are already seeing the sign that demand for traditional fixed income is starting to tighten. A major traditional asset manager now thinks the sovereign wealth fund or a pension publicly announces a restaking as their part of their fixed income replacement strategy by Q3 of 2026. If this happens, the yield gap will close fast and the capital rotation accelerates beyond the current projection. Next is the base case, the 60% probability. In this case, the institutional restaking will continuously grow 20 to 30% quarterly over quarter. Regulatory clarity remain in a gray zone here. In this case, it will be restrictive enough to slow down the retail, but open enough to institutions need the flow. The yield gap between government bonds and restaking is still in place through 2026, but it doesn't get big enough or desperate enough to force central bank to react until Q4 of the 2026. This is the point where the asymmetric opportunities still exist for the private investors who are persistent. Next case is the bear case, like 24% probability. A cascading slashing over multiple ABSs will trigger a liquidity crisis in the market, like the liquid staking token market. The same collateral securing multiple protocols or systems will break simultaneously. Here is the clear line in the sand. If EigenLayer T will break below 10 billion, like quickly, that's a black swan signal here. At that point, that means this thesis is over. You exit immediately. The rotation we talked today, like money moving from government bonds to restaking protocols, that's only half of the story here. The real question is, where does the money go next after the restaking protocol? The thing is that after it moves to the restaking layer, it flows into revenue generating protocols that capture on-chain fees. If you want to understand how the next layer works and how the money will compound downstream, we will create next video. I will see you in the next one.